We have with us Abhishek Singhal, Business Head, Passives and Alternate Strategy, ABSL Mutual Fund. Now, he's someone who comes with more than 20 years of experience and is responsible for setting up the foundation and strategic roadmap for the company in the area. Joining Mr. Abhishek on the stage, may I also please invite Mr. Aman, who is presently designated as the Vice President and Head, Index Development Research and Analytics at NSE India. And in his present role, he's responsible for developing new innovative indices and ensure commercial success of Nifty indices, including a suite of market cap-based to smart beta factor indices. Our next speaker, we have with us Chintan Haria, Head Product Development and Strategy with ICICI Prudential Mutual Fund. He anchors product development and strategy and is responsible for driving new and existing products and working closely with the respective teams to augment business growth. And of course, that leaves us with someone to moderate the session, none other than Mr. Prem Khatri, founder and CEO, Cafemutual. So can we have a huge round of applause to welcome all our speakers, our final panel discussion before our final keynote session. Here we go.
Actually, I'm no expert on passives. I've never actually understood quite what ETFs were. I'm not sure if I even understand today what ETFs are. But a couple of things I've been able to pick up. One is that passives are actually very versatile. In many ways, they're more versatile than actives can ever be. They offer a range of possibilities which active cannot. So far, throughout the day, we've been focusing on equity passives. We focused a little on debt passives. There was one session on that. Through this particular session, what I wanted to do was to expose you to a lot of interesting concepts. And these are very interesting concepts. They make business sense for you. They make investing sense for your clients. So without much ado, I'm so happy and proud that seated next to me are some people who understand this category very well. So without much ado, let me start over by asking Aman, who works with NSE, on, I'm a little confused about why passives are turning active. Smart beta sounds like a very much of a factor fund, sounds very much like an actively managed fund. So please tell us what exactly is a smart beta and how does it work?
Sure. Good afternoon, Prem, and thank you for having me here. So the critical difference between an active fund and a passive fund, or an active strategy or a passive strategy, is, as was also previously discussed in one of the panels, was the stock picking acumen. Is it left to the fund manager? Is it more discretionary in nature? Or is it rules driven? Now, traditionally, when this entire passive space started, it started with a traditional market cap-based strategy where the factor for selection of stock was size. So, for example, Nifty 50 has the top 50 blue chip large cap companies in India. It is also a factor index in a way. Why? Because the factor for selection in Nifty 50 is size, or liquidity, or free float market cap, and so on and so forth. So size being the factor, that there's no discretion around selection of stocks in the Nifty 50. Now, when you graduate from there, from a traditional market cap-based stock selection, we get into more adventurous space within the passive. One could be sector or theme. So, for example, the bank, IT, consumer durables. These are sectors where you would want to have exposure to. Now, there are two ways of doing it. You ask the fund manager, here's my money, please invest that into a sector active fund. An other way of doing the same thing, maybe through a low-cost vehicle, is the passive sector fund. Now, which could be a bank or an IT or a consumer durables, for example. So is it really active? Maybe your decision to invest in a traditional market cap-based strategy versus a sector fund versus a thematic being ESG or Sharia, for example. So if you have a philosophy of investing in ESG as a concept, or Sharia as a concept, that's your active call. Once you've made that active call, the vehicle to get exposure to that strategy could still be passive. Moving on from ESG and Sharia, there's on the fixed income side, which is now, you will be surprised to know, you'll be pleasantly surprised to know, after market cap based strategy, the second largest category today is the target maturity based debt ETF stroke index fund, which was almost non-existent 4 years ago. 2019 is broadly when this target maturity based debt ETF story started. Again there, unlike a fund manager who selects what credit he or she will buy, here it is more about sticking to the index, which could be a roll down AAA, PSU plus SGL combination, and I'll maybe talk about it more in the subsequent part of the panel. So once you've made up that call that I want to invest in an SGL plus PSU combination, which is definitely an active call, because you've taken a decision of investing in an asset, within an asset, a segment, within a segment, a particular strategy. That's the active call. You leave it there and then let passive take on from there. If I were to broadly talk about the passive space today, it's reached around 4.8 trillion INR. I'm talking about debt and equity, ETFs and index funds put together. Around 89 indices today are tracked by around 214 passive funds, both ETFs and index funds. I lost my confidence when I gave this answer, and it was wrong.
Yeah.
I thought I should be leaving this panel right now. But fortunately, it is more than 200. A large, any guesses out of 214, how many are linked to market cap based strategies? Only 99. Which means more than 115, around 115 passive funds, both ETFs and index funds, are linked to strategies which are non-traditional in nature. It could be smart beta, it could be thematic, it could be ESG Sharia, it could be multi-factor, it could be fixed income. Strategy-based indices, and I'll like to talk more about it maybe in the subsequent part, is where a factor is used for selection of stocks. Now, as I said, Nifty 50 is also a factor-based index where it's size. From there, when you move on, there are other factors that you may be interested in. For example, quality. So I want to invest in stocks which are quality companies. It could be a discretion to select what is quality company, or it could be a set of rules that you would want to define for yourself. For example, higher profitability, higher cash flows, low leverage, low variability in earnings growth could be the rules for me to define what quality is. Value, for example, low price to earnings multiple, low price to sales multiple, low price to book multiple, low price to dividend multiple. If these are the rules that I'm using, I'm actively selecting my strategy, but passively selecting the stocks, if I make sense on that. And finally, there's other debt, which is a small segment today. So with that, I'll maybe take a pause here. And
I wanted to ask you, what's the difference between a smart beta and a factor?
I would believe they are used interchangeably. So I would put it this way. There's a basic beta, which is something what Nifty 50 delivers, for example. And then if I were to be smarter and try to outperform Nifty 50, there are again two ways of doing it. One is the alpha route, which we've all been talking about it through the day. And then maybe there's a smarter beta, which is still passive, but try to outperform the basic Nifty 50 returns. For example, I have some numbers with me. If you look at the last 16 financial years, from 2007 to 2022, 31st March 2022, broadly the market at an aggregate level, large cap, mid cap and small cap, have delivered returns in the range of 12.5% to 13.5% CAGR. Large cap and small cap have delivered around 12.5%, mid cap have delivered around 13.5% return. Interestingly, factor-based strategies, be it quality, value, momentum, alpha, or low vol. These are broadly the 5 factor-based strategies globally and in India. They have outperformed the basic beta over the last 16 years on a point-to-point basis with quality and value delivering around 13% odd, low vol delivering around 14.5 odd, and momentum and alpha delivering around 17.5% on a point-to-point basis. Now, if I get these numbers, I get excited about factor strategies. This excitement has to be taken with a pinch of caution, because although on a point-to-point basis, the factors have outperformed basic beta, there's a high amount of cyclicality and volatility of returns within the factor strategies. So is there a single factor strategy which has always outperformed consistently Nifty 50? Not really. Every year, there's a factor rotation. Every year, the best performing factor is different. So can I predict which factor is going to do well? Maybe not. At least I don't have the capability to do that. Can I at least generalize and say quality and value, for example, have been outperforming during recovery? Yes, empirically observed. Can I say that low volatility strategies typically outperform when the market is generally bearish? The answer is yes. Can I generalize based on observation that momentum and alpha strategies, for example, have been outperforming more often than other strategies, but at a cost of higher volatility? So now it is up to me to decide how much to put in Nifty 50 based passive funds, only within the umbrella of passive, how much to put in maybe Nifty 50 based traditional market cap based basic beta, and then maybe be a little adventurous and put 20, 25, 30% based on your risk appetite and so on and so forth into adventurous strategies like these, which on a short run basis may not outperform, but over a longer period of time have empirically been observed that they've outperformed.
So these go beyond plain vanilla products,
Yeah.
and they're kind of like the toppings, Now, Chirag, you've been talking about commodities. So are there any opportunities in commodities beyond gold?
Yeah, so thanks, sir. While Aman mentioned about the journey of ETFs, I was just looking at my own journey since 2016, 2015 and when I became head of products at ICICI Pru. And probably that will answer your question as well as the entire journey of passives in India. That time we had about 2 passive funds, and today we have more than 25. And that just shows how much this industry is progressing, with probably less than 500 crore AUM, then today 30,000 crore AUM. The idea is that over the period as the industry has grown, not just the demand from investors, but I think the distribution mechanism itself has evolved. And I think the previous debate was active versus passive. I generally say, and I've been a fund manager on the active side in my earlier days, it is not active versus passive, it is active plus passive. And I have no doubt in my mind, as sir was mentioning, that there are many products which will complement the active side beautifully on the passive side. One was mentioned, gold ETF, of course, which is not possible on the active side. The other one, silver, which I think I and Abhishek were first to launch in our own funds. And I think silver is also picking up. There is talk of crude at some point of time to come in. Maybe it's not a retail product. So there will be more and more products on the commodity side which we believe will come, but gold and silver predominantly at some point of time. We would also want to bring to the investor through the mutual fund route, maybe a combination of commodities. Aluminum, copper, zinc are also traded very well in India. Currently the open interest, etc. are low, so they are not very well evolved. But as mutual funds get in, obviously it will probably see a depth increasing. On the other side, apart from Nifty Next 50, small cap, mid cap, as we graduated, we felt that smart beta was something. And back in 2017 beginning, when I think we were working on the low wall together, we made it in a way that 30 stocks out of 100 and low wall globally did well. We said Indian audience should also have it. From 2017 till 2020, the low wall ETF, which I had thought was a great idea, did not pick up and was less than 20 crore in AUM from 2017 July to 2020. Something changed in 2020, and that's why probably we are here and this big audience is there. It is more than, I think, 1,300 crores in AUM today. Last 2 years has seen this significant growth in the adoption by family offices, by RIAs, by large investors, and we are seeing daily inflows. It's not something which we see in normal funds as well, but daily inflows in the low vol as a category. So globally, of course, momentum has probably been the best factor, followed by low vol. That's a thing of the last 7 years where high quality bucket has done well, and low vol generally is heavy on quality, which is basically consumer names IT. But apart from that, if we move one step ahead, so we've seen traditional ETFs, then we've seen smart beta, which is low vol. We were the first to launch alpha low vol, which is like giving a thrust to a combination of speed plus safety, which is alpha generation plus safety. India's first multi-factor smart beta ETF. That is still not caught ground. I think we launched it about 2 years back, in the midst of lockdown in 2020. I think that will also eventually catch up. Now let's look at the solution oriented. We have the building blocks of all the products in place. But what is in it for the investor and how you get? Aman mentioned that you have to pick and choose the right one. The factors keep rotating. Will you be able to individually go to all your clients and say, okay, the factor has changed from alpha to momentum to value and change it? The answer is no. And that's where we thought of fund of funds as a brilliant idea for all of you to allow your investors to participate in the markets. Fund of funds for factor-based ETFs are already available. So the low vol has a low vol fund of fund, the alpha low vol has the alpha low vol fund of fund. The BSE 500 has the BSE 500 fund of funds. So for individual, it is available. But as a solution for picking and choosing the right ETF, be it commodity, be it equity, be it debt, be it international, and packaging it, that's where the fund which we launched couple of months back, I think as a solution, which is the passive multi-asset fund of fund, is a brilliant solution to get the exposure to passive in one umbrella, which is called the ICICI Prudential Passive Multi-Asset Fund of Fund. If we look at themes which Aman mentioned, I think we were the first to launch the private bank index, the first to launch the auto ETF, first to launch even the IT. And all of these are available. And what is the beauty about these? For example, in an active fund or in a sectoral fund, there will be a limitation to which exposure a fund manager will be ready to take on a single fund, on a single stock, right? They will probably keep it at 20, 25 or lower. But in a passive fund, your investor will exactly know what he is getting. So if it's a bank ETF, they know that the top holding is 33%, the next holding is 25%, and top 5 will be 80%. That's possible. So if you're positive on Indian banking, which we are, that's where the banking index or the banking ETF will fit in well for your investor. For that also, we have a solution which is called the Passive Strategy Fund of Fund, which effectively underlying, it's an equity taxation product, underlying is all themes. So you don't have to worry about whether banking will do well or pharma will do well or auto. We are doing and picking and solutions. So from having plain vanilla products, be it silver and gold, Nifty, Sensex, etc., to moving towards creating solutions so that all of you can benefit. It's the eureka moment in terms of how maybe 15 years back we were thinking of the Balance Advantage Fund category, and now today the Balance Advantage Fund category is a household name and every investor is happy, and it is driven by distribution, it is driven by advisors. Similarly, we believe the Passive Strategy Fund of Fund or the Passive Multi-Asset Fund of Fund, which gives single solution access across the spectrum, are brilliant tools in the hands of investors to participate in the passive market, because it's very difficult to time and pick and choose, and for you to achieve scale and the nimbleness which is required in sectors and themes, it is important to have a solution which is controlled, monitored by the asset management company, and that's where we believe the multi-asset fund of fund and the passive strategy fund of fund are brilliant tools in the hands which we have created for you to scale up your business without having to worry about the investor experience. Thank you.
Abhishek, coming to you now, what are these thematic funds, sectoral funds, and on what basis do you select them?
So as Aman mentioned, the market cap indexes, Nifty 50, Next 50, these are the traditional indexes that we have invested in, seen from a passive point of view. But when you look at the active space, typically, in the first decade of the century, if you looked at the fact sheet, it was all about what are the new stocks that the fund manager has picked up. It was the age of stock selection. The next decade was more about how have these stocks been picked up. If you look at the top large cap funds, in fact, pick up the top 70% of the portfolios, you will see that the portfolios are largely identical. Where is the differentiation coming from? Differentiation is now coming from the overweight, underweight to different sectors that is happening. And then there are these macro themes or some sort of mid themes which are playing out. Digitization is one such theme. ESG is one such theme. Manufacturing is one such theme. Comeback of manufacturing. Conversely, you could look at services as one such theme. When you look at these themes, when you look at these sectors, you can actually look at these as a building block. Very interestingly, we were looking at 2015 as maybe the second birth or the first birth for passives industry as it stands today. At that point in time, the overall thematics active funds in the marketplace were just about 28,000 crores. Today, in active space, it stands at about 80,000 crores or maybe about 100,000 crores. Passives, incidentally, has itself already reached about 80,000 crores. And this is, if you were to look at, let's say, the top 5 sectors or top 5 themes, banking and financial, you could look at healthcare, you look at IT and digital, pharma. Today you have about 70% of total market cap well covered with ETFs or index funds. Effectively speaking, you can actually build a portfolio if you want to take a call on asset allocation for the investor. How to build an aggressive portfolio? You could have a high beta portfolio with more of banking, more of financial services, maybe even auto, or you could have a slightly more resilient defensive sort of portfolio, more IT, more healthcare. So today, the idea is, can you put a tailwind to a portfolio? Can you build some sort of safeguards in the portfolio? Using passives, even active fund managers can actually use some sort of navigation. They want to go overweight, underweight certain stocks without creating too much of churn. Create a core of, let's say, some thematic index or a ETF, and then you could look at a plus minus on whatever stocks that you can do. RIAs are incidentally finding it the most useful thing. If you look at the banking index or banking ETF space, it was hardly about 7 or 8,000 crores. Today, that space alone has more than tripled. That one index is more than 20,000 crores in size. And that is, by the way, much larger than the active funds on the thematic side. So basically, even as from the active side, it is generally said that it is for more evolved investors, for more active, aware investors. Similarly, on the passive side as well, while investors are already trading in stocks, today, I would say it's a much safer bet looking at a bunch of these top performing stocks as a basket. So if you were betting on few banks, it's probably better to bet on a banking ETF. If you're looking at betting on, let's say, an Infi or a TCS, rather than that, as a new investor, your investor can benefit from investing in, let's say, an IT ETF or an index fund. And again, then you have these building blocks going into tools or financial planning models like asset allocation funds. And that's where they will start playing a much bigger role. So idea is broadly that you will have more and more of these sectors. Over the last maybe about 6 to 7 months, you've seen even the smaller sectors like in auto, even consumer durables, etc., being launched as ETFs or index funds. The risk is only one there, that of liquidity and cost.
Yes, I was about to come to that.
And I'm pretty certain in many advisors, they've been thinking about this all day. The impact cost could be pretty high in slightly smaller, less represented sectors or stocks. Yes, that is definitely a risk. But then if you look at the same Nifty ETF that today trades at 5 basis points expense or 10 basis points expense with a spread of maybe about 15 or 20 basis in the market, used to be the same difference, the same spread what thematic funds today are 5 years, 7 years ago. Give it more time, give it more size, and the next 3 to 4 years, you'll see that India is a market similar to the Western world.
Okay, Aman.
Maybe I'll just quickly build on what Abhishek mentioned. I
had one question. We are talking about so many different things. We're talking about themes, we're talking talking about different sectors. We're talking about those 5 this things which you said about low factors and so on. How does one here? How does one select what is the kind of product that I want to recommend to an investor? Because he can't be an expert on sectors, he can't be an expert on factors, he can't be an expert on commodities. Because eventually how that commodity fund will do is dependent entirely, and these are cyclical products. All commodities are inherently, some may have shorter cycles, some may have longer cycles, but they are. So how does, this is actually leading us to where a lot of confusion, at least when it is an active fund, मैं सब कुछ उसके सर पे मार देता हूँ कि ये इसने बोला था, इसने किया था, अब इसकी गलती है. लेकिन अगर ETF लेगा या इंडेक्स फंड लेगा, then that blame comes on to me. It's not on the fund manager.
Maybe I'll take a stab at that. आप जब गाड़ी खरीदते हैं, typically you end up buying the accessories from the same brand. You remember that Maruti used to have a sub-brand called MGA, Maruti Genuine Accessories. Remember, every time you had a service requirement, you would go to the same manufacturer. It's pretty much the same. If you've already been experienced, benefited from the active business already, and I'm not saying that, it's active versus passive. I completely agree with my friend Chintan here that it's active plus passive. Eventually, at some point in time, there will be a phase when you will see India behaving like, some of the developed markets. The AUMs being as large as active or maybe even larger than the active space. But till such time that happens, look at it as, a set menu. These are, sectors, themes, smart betas, these are parts of the portfolio. And when you're looking at taking a solution from a certain fund house, the same fund house, you could additionally look at a certain idea.
लेकिन मेन्यू इतना लंबा है कि कंफ्यूजन होता है कि कहाँ से शुरू करें.
So उसका भी एक solution है जो चिंतन ने अभी बोला था.
चिंतन ने बोला था कि वो मल्टी एसेट वो तो है, लेकिन आप सब लोगों के पास में तो नहीं है.
Incidentally, we have a solution for advisors, something called a financial planning fund of fund, or something like what we are looking at creating on the pure passive fund of fund, where I'm not actually exposing the investor to only, let's say, a Birla product. I'm actually looking at exposing the investor to some of the best products that I think are out there in the market. At some point in time, my product will be the best, so I will buy that product. At some point in time, let's say a Pru product would be better, and I will buy a Pru product. So you have very, very transparent, and that's the beauty about passives. Everything is out there, and it's available at such low cost. These financial planning tools are some of the best ideas that one can look at, especially from an advisory space. People who want to allocate could use these specific tools, index funds and ETFs, but somebody who wants to just simply have a manager select some of these best tools, you have a fund of fund.
Maybe I'll just add to that, and this is a very genuine problem because maybe there's a problem of plenty.
Plenty,
and
absolutely.
This is exactly where advisors, the role of advisors kicks in. I mean, if I were to draw a parallel here, this is like index providers are like restaurants providing a lot of variety of food on the menu, and maybe advisors are like dietitians.
Are like?
Dietitians who decide what you should eat and what you should not eat.
Okay.
So there are two parts to your question. One is, as an index provider, if you were to take active calls of whether you want to be in large cap, mid cap, small cap, within large cap, sector 1, sector 2, sector 3, or maybe theme 1, theme 2, theme 3, or strategy 1, strategy 2, strategy 3, do you have a low cost vehicle that can give you access to that strategy if you believe that strategy is good for the overall portfolio of your investors? So that's something that you decide as advisors. Swaroop also mentioned that in the previous panel. And that's a very, very valid point, that it's for you to decide what's good for your clients. There's no one-size-fits-all approach that works for all your clients at all points in time. But if you were to take a call that if there's a spectrum of investment avenues, do you have a low-cost vehicle that can give you exposure to that and a good entry and a good exit at any point in time? That's where availability of so many indices comes in. So I was saying that today there are 89 indices on which there's at least one product available in India, a passive product
So
available.
there are 89 different categories of passives.
I would not say category. Broadly, categories, broad, sector, theme, strategy, debt, and constant maturity versus target maturity. Broadly, these are the categories. But I'm saying there are 89 unique indices on which there are 214 odd products available. So is it plenty? Maybe yes. But do you need all? Maybe not. Do you need, whether you need 10, 15, 20, something that the advisors have to decide for them, for their clients.
So there is an analogy which I'm drawing in this discussion. When in 2013 we took the Balance Advantage Fund, and I know Balance Advantage Fund is known to everyone, most of the advisors or distributors at that time, there were no advisors, everyone was a distributor, thought that this is my job. I'm supposed to allocate between debt and equity. I cannot give it to you. And then eventually everyone adopted, because India is such a large country, and having said that, even today probably, the Balance Advantage Fund category will have not more than maybe 20 lakh investors total, all industry put together, right? And so it is not about you deciding for the investor whether debt and equity. It is about us together taking that to a different scale altogether. 8 crore, 9 crore demat accounts, this category, which is Balance Advantage Fund category, can have probably 1 lakh or 1 million, 2 million, 3 million more every year. On the passive side, which is what we are discussing, we felt that there is a similar solution which is required, specifically because there are so many options which were opening up, so many categories. And so everything we brought into one, which is equity, debt, international equities, and commodities, which is gold, into one, which is passive multi-asset. And as far as the sectoral part is concerned, because sectors have these movements which are quite quick, to avoid your clients from taxation, to avoid your clients from, there's no question of exit load in ETFs, but more so taxation. And how many clients can you go and say, okay, move from one to the other? The problem which we were facing is, we were giving a call on a sector, by the time it reaches you and then your client, it's a 6-month lead time, and that sector has played out. So that's where I believe the passive strategy fund of fund, which is a great solution created for the clients to invest in the auto ETF, banking ETF, and we can keep on moving together, bringing our, let's say, understanding of the markets to you and your investors to that fund, is a brilliant solution, because you will have a lot of options, and those options are only going to increase. I think I and Abhishek are not going to stop where we are in terms of products. We'll have probably, as of now, I think we already have 20 lined up for investors to get an option to choose from themselves. But if you cannot choose or you find it difficult, then the passive multi-asset fund of fund or the passive strategy fund of fund, each has been created for you to take the benefit of it. Of course, individually, if again many of your clients don't have ETFs, you can go through the fund of fund route. So low vol, BSE 500 or alpha low vol, gold, silver, all of them have their fund of funds for non-demat clients to also invest. But I think these two strategies or these two fund of funds are something which all of your investors should have, depending on whether they want to go the thematic route or all the sectors or all the asset allocations together. Thank you.
Okay, while talking about so many categories of funds, within a particular category, other than costs, how do people decide about which fund to select? Within a particular category, other than costs, what should they look at while deciding which fund to invest in?
So I think, especially post-categorization, there is sort of one discipline in place that in almost every category, fund houses are not launching maybe more than 1 or 2 products. So if you were to look at, let's say, sectoral, I don't think anybody would have 2 banking funds or banking ETFs. Unless it's a differentiation that one is a pure private bank and the other is a PSU bank. Again, on, let's say, something like healthcare and...
No, but between 2 brands, ICICI and Birla, how do I choose?
So again, as I said, when you, and that's the analogy that I was drawing from the auto industry, when you are buying the first product or an active product from, let's say, a Birla, you could have bought my frontline equity. But now that you are looking at buying into a healthcare story, especially post-COVID, you could just simply add on to a healthcare product from Birla itself. When you go to the exchange and you see, let's say, there are 3, 4, 5 different healthcare products, that's where A, the brand, B, the liquidity of that product, and 3, because it's a low-cost solution, the cost of that solution become very, very relevant. So also beware that the cheapest solution may not be the best solution for you. So sometimes whether that solution is apt or not for the investor is the first consideration, even if it comes at slightly higher expense. But within a category which has multiple producers, multiple products available, and if these are commoditized products, similar products, no differentiation, it's an index, then just simply go for the most liquid and the cheapest solution.
So maybe I'm the most independent between the three of us to answer this. The simplest answer to that is that once you've made up your mind that I want to invest in a particular sector or a theme or a strategy, I think there are three factors that are important if it is ETF. One is, of course, the liquidity on the exchange, because the reason why you've chosen an ETF over an index fund is maybe you want to play intraday, potentially. So liquidity is important. Cost is definitely important, assuming that the tracking error is lower. So these are three factors which are important to be considered: liquidity, cost, and tracking error. Tracking error basically is a measure that shows how close you are or the returns are to the index. So tracking error, too much of tracking error is bad. If it's an index fund, then definitely liquidity and it would not matter that much. Then what would matter is, again, once you've taken the call that that theme is suitable for me, the cost and the tracking error. So these are the two things that are important.
So I think just quickly, since I think we are running out of time, the commitment of the asset management company towards that business matters. Whether they are, apart from, of course, they having a low-cost product, which obviously all of us would want to have a low-cost product, whether it is being efficiently run, the tracking errors are low. And I think in the last 1.5, 2 years, a lot of me and my team's bandwidth has gone in ensuring all of our schemes are run in a manner which is beneficial for the investors in terms of tracking error, lower costs. And the more products you launch, obviously, you need to be ensuring that they are run efficiently. The ecosystem is still developing. I wouldn't say it's at its best in terms of infrastructure, in terms of even the market-making infrastructure. But I think as we grow bigger, and just to add to Abhishek's point, as more investors come into the markets, liquidity will beget liquidity. In the equity markets, maybe 25 years back, the spreads were much higher. Today they are in bips because now everyone on the exchange is going, buying, selling. So the more number of investors on the exchange, the spreads will come down even for the ETF. So I think the ecosystem is just about developing and growing. As maybe 3, 4, 5 years down the line, all of these issues will auto-solve in terms of liquidity on the exchange. And we'll have a much more booming ETF infrastructure as well as the industry. Thank you.
Okay. Now, we are open to questions from the audience. You will not get an opportunity to meet product specialists like these three here. So please take advantage of that.
Ladies and gentlemen, this is our final panel discussion before our keynote session. So let's make the most of it. And let's have your questions, please. We'll have the mic passed on to you.
One thing that I've seen, these tend to be very much be trend driven. So you yourself said that there was some product that you'd launched, you saw it for 3 years and it didn't grow, and then suddenly it took traction. Now, clearly, what goes behind the thinking in launching such products when there's no ready market available for it? Because every AMC I know, if you go to the SEBI website, every AMC has docked some 10, 15, 20 offer documents of passives. So what is the thinking which goes beyond कि हमारी ये product pipeline पूरी कर देंगे और फिर जब time होगा तब हम आगे दिखाएंगे? Is that because you know what happens is, as a distributor, I take you less seriously because you have launched 15, 20 products and none of them are of any worth size, don't have a track record. So that becomes a big challenge for us. My faith actually in the category goes down a little.
Yeah, so just two parts to it. In India, most of the financial services, which when they are new, the scale is not a challenge because we all know that no matter what we launch, there will be an audience for that. And with the RI community growing, with the distribution community growing, with the investors' interest in passive growing, like for example, when we launched the low wall, we felt it's a good product for the long term to fit the overall allocation. It did not pick up for 4 years, that's a fact, but it did not make it a, let's say, subpar product. So the product which we launched first initiation stage, whether it is good for a specific category of investors when they are looking for an appropriate solution for their overall balance of portfolio. And second is, will there be a demand? I don't see a challenge. If silver, which was launched recently, I think silver, gold obviously is a 15,000 plus crore product, but silver also will have a demand eventually. So the building blocks have to be in place. All of us will try and bring out. Just an example, banking ETFs were there for a long period of time, but the moment I think in 2005-06, the FII premium or the FII restriction came in some of the banks because India became a very hot destination. FII restriction happened in some banks. That FII money came via the ETFs, and the ETF category in banking became, at that point of time in 2007, I remember 20,000 crores odd. And then it came down. So we do not know which product will work when, but as long as the product makes sense, like we've launched the FMCG or the consumption ETF, it may not work right now, but there will be a time where people want to play the consumption story through the ETF route. And that time it will pick up. So we'll have the building blocks. The good part about ETFs is that there is a back end, there is a methodology, and you as a distributor and the investor know exactly what they are going to get. The universe is also defined. So I don't see launching a lot of products as a challenge. Each product will have its time in glory at some point of time. And eventually in 10, 15 years' time, all the products will have scale, is what we believe in.
So
I'll just add on to one more point to Chintan. So while this is the broader thought process that keep everything ready and time will come for it to fly. But even when we decide, which particular building blocks are we going to look at from a pipeline perspective, there is also a lot of thought, especially from an ETF perspective, that I've seen, and this is a maturity that has come in the industry also. We look at actually testing the product also in-house. What is the sort of liquidity? And Aman will validate that there is a lot of data that we ask the index providers also to provide. When we are going to get, let's say, 100 crores in or 100 crores out on a given day, can that trade actually be executed in the first case or not? And as every year goes by, now you are seeing that accidents don't happen. These kind of issues don't crop up as they used to maybe about 10 years ago. The liquidity testing, the expense testing, is there enough demand for it? That's the processes which are now done in-house even before we go for a filing.
Okay. With that, we come to the end of this session. So let's have a warm round of applause for this panel.